This video is made only for educational purposes. No stock ETF should be bought without advice from your investment advisor. Understanding risk. Very few terms in personal finance are as important as the term risk. Every investment carries some degree of risk, including the possible loss of principal, and there can be no guarantee that any investment strategy will be foolproof. That's why it makes sense to understand the kinds of risk as well as the extent of risk that you choose to take and to learn the ways to manage it. There are many types of risk an investor should be aware of. Volatility is basic risk. Generally, when financial advisors or the media talk about investment risk, their focus is on the historical price volatility of the asset or investment under discussion. Financial advisors label as aggressive or risky an investment that has been prone to wild price gyrations in the past. Other types of risk. Here are a few of the many different types of risk. Market risk. This refers to the possibility that an investment will lose value because of a general decline in financial markets due to one or more economic, political or other factors. Inflation risk, sometimes known as purchasing power risk. This refers to the possibility that prices will rise in the economy as a whole. For instance, your investment might yield a 6% return, but if the inflation rate rises to double digits, the amount that you get back on maturity would have lesser value than the original amount you invested. Inflation risk is a major worry for fixed income investors. Interest rate risk. This relates to increases or decreases in prevailing interest rates and the resulting price fluctuation of an investment, particularly bonds. There is an inverse relationship between bond prices and interest rates. As interest rates rise, the price of bonds falls. As interest rates fall, bond prices tend to rise. Default risk, that means credit risk. This refers to the risk that a bond issuer will not be able to pay its bondholders' interest or repay principal. Liquidity risk. This refers to how easily your investments can be converted to cash or sold without significant loss of principal. This basically refers to the availability of vibrant secondary market for that particular instrument. Political risk. This refers to the possibility that new legislation or changes in governments will adversely affect companies you invest in. Currency risk. For those making international investments, this refers to the possibility that the fluctuating rates of exchange between INR and foreign currencies will negatively affect the value of your foreign investment as measured in INR. Understanding your own tolerance for risk. The concept of risk tolerance is twofold. First, it refers to your comfort level to assume risk. If you find that you cannot sleep at night because you are worrying about your investments, then you might have taken too much risk beyond your comfort level. Second, your risk tolerance is affected by your financial ability to cope with the possibility of loss, which is influenced by your age, stage in life, how soon you will need the money, your investment objectives, and your financial goals. Reducing risk through diversification. Don't put all your eggs in one basket. You can potentially help offset the risk of any one investment by spreading your money among several asset classes. Share, give a like, leave a comment. Please subscribe our channel